Let's take a look at the markets. Asian markets traded mixed today, although the Shanghai Composite ended the session well over 1%. That's despite the implementation of a 104% import duty levied against China by the United States today. Japanese stocks were hit hard, though, falling nearly 4% on the day. The Nikkei share average declined by 3.93%. The Hang Seng Index actually rose by 0.68%, while the Shanghai Composite Index closed up 1.31%. U.S. markets ended the session in the red as players anticipated the kicking in of the higher U.S. tariffs on a number of nations, including South Africa at 31% and China at a whopping 104%, in response to that country deciding to retaliate against the U.S.'s original tariff hikes. The major concern now being impending inflation, while some players anticipate that the Fed could step in with interest rate cuts to help alleviate the massive sell-offs that have been taking place in recent sessions. The Dow Jones Industrial Average declined by 0.84%. The S&P 500 fell by 1.6%, while the Nasdaq Composite Index lost 2.15%. All right, let's take a look at, of course, our local indicators. The JSE is trading down 1.7% at 82,734 index points, while the Rand is trading at 1971 vis-a-vis the US dollar, 21.73 against the Euro, and 25.24 vis-a-vis the British pound. The Rand has actually improved somewhat relative to a few hours ago, where it hit as high or as low as 1982 against the US dollar and 25.48 somewhere there against the British pound. So it's improved, but it's still very weak. In terms of our commodities, we see that gold is trading at $3,041 an ounce, platinum at $903 an ounce, while Brent crude oil is trading at $60.18 a barrel. Let's get into conversation now with Chantal Marx. She's the head of equity research at FNB Wealth Investments. Thank you so much, Chantal, for joining us. So the higher U.S. tariffs kicked off from midnight today with a 104% duty levied on China. How is it that we saw that the Hang Seng and the Shanghai Composite Index close in positive territory today?
So both of those indices were actually under pressure overnight, but as the trading session progressed, they actually started pushing higher. And a lot of that has to do with the fact that Chinese authorities have decided to step in and support markets. So both from a monetary policy perspective, they've committed to loosening monetary policy to help consumers as well as the broader economy and markets, and they're directly interfering as well. So looking to buy stocks and bonds in local currency. That explains why we've seen this disconnect from the rest of the world, where markets have generally been under a lot of pressure over the last 24 hours.
Well, it's great that the Chinese authorities have these bazookas, but it doesn't change the fact that the fundamentals stay intact, that American consumers are going to have to pay significantly more, 100% more for goods, in terms of the US tariffs on China. And they may decide that actually, no, we don't want these products anymore, and that would affect Chinese producers. So in the long run, does it really make sense them intervening in this way?
Well, I think it's the only thing that they really can do to prop up the economy currently. What we've also started seeing from a Chinese perspective is they've started buying local currency. They're divesting, or they've at least stopped buying US dollars. And that has resulted in a weakening of their currency. So that should make their goods slightly more appealing, because it will make their goods cheaper for a consumer using US dollars. They've also implemented retaliatory tariffs. A few minutes ago, we saw that they've now instituted an 84% tariff on US goods. So I think that they're trying to take a hardline approach here. It is the second biggest economy in the world. The export sector is extremely important to them. So I think that they're taking a strongman approach, whereas from the rest of the world, we've actually seen a lot of countries deciding to kind of take the opposite route. Vietnam, as an example, decided to zero rate goods in order to not have that tariff impact from the US. I think the Chinese are just in a position of a bit more strength, but it's no good for anyone. It's no good for global growth in any event.
Not at all. I mean, we did see earlier President Trump boasting that countries are lining up, to negotiate individual trade deals with him. So he obviously seems quite pleased about that. Let's move on. So we're told that as players sell off on the equities market, they're pouring into safe haven assets. So why aren't we seeing the price of gold marching ahead that much more substantially than it is right now?
So I think a lot of the big buying in gold already took place over the last 3 years. So we'd kind of put the start of the current gold bull run in about February 2022 when Russia invaded Ukraine. You then saw central banks increasing their buying quite significantly, particularly as sanctions were levied on Russian US dollar assets. And you already had a big kind of push towards gold from institutional investors during that time as well, because we had quite a bit of geopolitical upheaval. So those allocations, I think, were already made. And what we're seeing now is the last remaining push coming through from guys trying to get more safety in their portfolios, and also from retail investors moving into gold. But I think that the big gains have already been made. What can also explain the fact that gold hasn't moved up by more is that a lot of investors are in a position where they actually have to find liquidity somewhere, and gold has performed quite well. So perhaps funding, it's being used as a funding mechanism. And then finally, I think a lot of investors feel safest in cash. So perhaps just getting out of kind of any asset outside of cash in any event.
All right. So how concerned are you about the local currency's substantial weakness? Of course, it's improved somewhat by some cents or so, but it's still very weak, and already immediately implies inflation very soon. In the next couple of months, no doubt, we're going to be hearing that inflation has ticked up more than a couple of percentage points.
Well, it depends on how long the currency remains this weak. The currency has depreciated in line with emerging market currencies and then some. And the then some has to do with the instability that we're seeing in the GNU currently. So I think if we can get some sort of resolve from a political standpoint, and that we should get within the next month or so, we could see we will have a better idea in terms of where the rand will settle. You need sustained rand weakness in order for it to translate meaningfully into inflation. And then on the flip side, we also have extremely low oil prices. So perhaps that could provide some sort of a reprieve on the inflation side, because oil is our biggest import into South Africa. And if the oil price is where it is currently, and that is sustained, that could counter some of that rand weakness for us.
All right, super. Thank you very much, Chantal. Always appreciate your insights. That was Chantal Marx. She's the head of equity research at FNB Wealth Investments. After a short break, Juliet will have more news for you.